Hi friends, I'm Harshit Jain. I hope I'm audible and visible to every one of you all. Thanks for joining in. It's a pleasure taking this webinar. To brief you on my background, I've been involved with MyCFO since past 3.5 years. So this is pretty much it about myself. I hope you have a good session. What we'll go through is we'll go through slide by slide of what I've prepared for the budget. If any queries or anything, you can email me the questions as well. So I hope my presentation is visible to everyone. The topic for today is tips and aids to high quality budgeting and business planning. We are at the close of the financial year, okay, and we need to start planning for the next year. So I'll take you through the key areas which we need to look at, and I'll probably assist you in understanding few of the areas which I faced while doing the budgeting at some of my clients. So I'll start with the budgeting. What is budgeting? Basically, it's a process, it's a methodical approach for business planning. It's a process where we identify few of the components and we assign value to those components. But is the definition making it very easy? It's not that easy. It's how close to accurate we forecast determines the success of a budget. Just to have a small disclaimer in terms of the target audience, where I think the target audience is for the persons who are preparing the budget. I hope they find the benefit out of it. So why is budgeting required? To define the path of the business for the next 1 year. Okay, we need to understand where we are heading as a business in the next 1 year. Okay, what are the key decisions we are going to take and what are the objectives we have in mind, okay, and how we are going to achieve that. Also, to achieve the targets, we need to drive the efficiencies within the organization. We need to uplift the people. We need to give them better visibility in terms of where we want to head as an organization collectively. We also need to understand from a business standpoint, will we be able to generate enough revenues to cater to the spend or no. So basically, it's all about profitability at the end of the day. We need to understand whether our revenues will be enough to sustain the business. This is a process flow which I'm planning to take you through the entire session. What we'll go through is what are the basic process flows for a budget. Planning, there is responsibility, there is approach, which are the tools and pointers. So it's specific to a P&L or a balance sheet or a cash flow. These are the financial aspects. And monitoring. How do we monitor the budget going forward? Key areas within planning which I want to take is that we need to define the objectives. Okay, we need to understand what we want to achieve during this year. What are the timelines when we should start the budget and what are the timelines we should give people and what are the templates we should give the departmental heads. All will be part of the planning process. The responsibility aspect is who's the driver. The accounts and finance function is definitely the driver. There are departmental regional heads who will support the budget, and the final approval will be from the management, CFO or the board or the promoters. There are different types of approaches to a budget which we'll be discussing in detail, different tool pointers and how do we monitor the budget month on month going forward. Planning, outlining the business objectives. As a finance head or as a finance controller, what I need to do is I need to sit with the management, I need to sit with the CFO and the strategy makers. Understand what kind of strategy are we trying to adopt in the coming year. First is that my existing business, how it's planning to grow in the current year. We need to understand that the existing business will grow properly or no. What are the additions to the existing business which we want to incorporate? Is the new product level to be launched? Any new products? So now once you launch a new product, there will be different cost elements which are associated to that. So for example, there is a manufacturing cost or purchase cost to a particular product if you want to launch. If you're launching, you will also require marketing spend. Similarly, for a segment, you need to create various service lines, you need to create sales lines. Now, if you're planning to open a new region, you need to rent an office space. You will need a regional head to maintain the operations in that region and other operational costs which are associated to that particular region. So these are few of the examples which I'm giving where this vision to prepare the budget will come from the top management or the CFO or the high level stakeholders. Also, we need to take their views in terms of the top line and profitability. They might be of the vision is that this year the top line has been X rupees and we need to reach to an X rupees top line. Okay, we need to get profitable this year, we are at loss this year or something like that. This will be some kind of discussions which you want to ideally incorporate in the budget. Whether you have enough reserves or enough liquid funds to support this vision or not. Few of the questions should come from a finance head to management, CFO or the stakeholders. Understand those replies, keep those pointers and factor it in the budget. There are various other areas where probably you'll be able to understand better in terms of planning from the CFO or the promoters. The next question is that okay, you have done the first sittings with the CFO management. So how do we start and when do we start? What is the timeline to actually prepare the budget and implement it? When do we start the budget preparation? So I think it's technically in the last quarter of the financial year, Jan to March quarter. The earlier we start with the planning, the better the time available to make it detailed. First cut of the budget should be ready by February end. That is the draft budget. It should be ready by February end. So the board and the management approvals will take 2 weeks of March. If there are any final tweaks or changes which are occurred during the approvals or during the discussions, we need to make those final tweaks, and the budget should be rolled out by 15th of March so that we are able to implement it from 1st of April. So basically it's a month and a half you get probably to plan and organize the budget and keep it ready and implement it from 1st of April. Now, who are the responsible persons to drive the budgets? I think as an organization as a whole should be responsible to drive the budgets, but the primary responsibility lies with the accounts and the finance function. The accounts function or the finance head prepares the budget, plans how to allocate time, allocate the templates to various department heads, and then bring it all together. So the driver of the budget is the finance head. Now, who are the support functions? Departmental heads are the support functions. We need collective data from the departments. Okay, so operational data, what you say is operational data will come from the departments. What defines success of a budget is that you get all the operational parameters right, and then the outcome of it is a financial representation. So operational parameters will come from the departmental heads. Who are the approvers of the budget? Obviously the promoters, directors and the board are the approvers to the budget. Moving on to the next slide. What sort of approaches you need to take for a budget? What I feel is 3 kinds of approaches which we've been engaging with our clients, and these are the approaches we've been taking. The top-down approach. So what is the top-down approach? The management decides the targets. Okay, we sit with the management decides the targets, the management decides the key numbers that needs to be achieved in terms of top line, bottom line. What happens next is that once the management decides the number that this number is to be achieved, it's then again rolled down to the department's sales team key personnel. Okay, so this is a top-down approach where typically management controls the outcome, management controls the overall numbers to be achieved. The next approach is a bottom-up approach. What we do is that we take targets from the departments, sales teams and the key personnel involved in the organization. So these are specific targets which we take from the department. So the department as a whole is accountable to that target. What next we do is roll up that departmental budget or departmental P&L into a finance performance. Once that is rolled up and we have a structure in place, we go ahead and take an approval of the management that these are the targets which are given by the department heads and the sales team, and these are the targets we want to achieve during the next financial year. There is another approach, is a combination of both. How this combination works is that there are some targets and the key numbers to be achieved which management decides in the next year. What separately is also done is that targets are also provided by the departmental sales structure and the key persons. Now we'll have 2 separate budgets or high level budgets. So management will give a separate top line, bottom line and the key targets to be achieved, and we'll receive targets from also the department. Now there will be a gap between what the management wants and what the departments think they will achieve. So what we need to do is that we need to determine that gap between the 2 plans, and then we should ensure that there's a discussion in place and there will be a final agreement between management and department head, and the budget will be rolled out. These are the approaches which we take at our clients, and I would suggest the combination of both. Also the bottom-up approach. The top-down approach is somewhat like a difficult approach where the targets get difficult and the budget quality and the budget outcome is not that perfect. The bottom-up approach, I think, makes a sensible approach where we are taking targets from each of the team members and then correcting it with the management, saying that, okay, boss, these targets are lower or higher, you need to lower them or higher them. And the combination of both is probably a task in itself, because there is the 2 separate numbers you are working on to collate them and ensure that there is a plan of action between all of them, and there is a sync between the management and the department. It's a bit tricky, but I think it's manageable. I would suggest that we should ideally go for a bottom approach or a combination of both approach. I have 2 templates which I want to walk you through before getting detailed into the budget preparation and how we want to understand. The 2 templates which I have worked on personally is a hospitality model. It's a resort, it's a 80-room resort which I have worked on, and I prepared a budget for that. And another is orthopedic implants distribution. There are 2 different vague models which I have taken in so that there is a feel of the budgeting difference which we've faced across different clients. Specifics to the model. Hospitality, it's a resort like I mentioned before. Here we had taken an approach of a combination of top-down and bottom-up approach. Okay, where the management had some views on the profitability and the revenue to be achieved, and also what we had done is we had taken all the details, all their targets, key targets to be achieved from all the departmental heads. We also will be able to understand which are the key operating levers which we need to target when we prepare a budget for a specific organization or a specific kind of business model. The seasonality trend will also kick in. Why I have taken this model to explain is that there are several sales segments within this budget which you will be able to understand once I explain it, and there are several cost parameters. To give you an example, sales segment will be your food sales, your liquor sales, your room sales. The cost parameters include the food cost, the electricity cost, the power cost, the generator cost, the employee cost. These are the few areas I want to run through. The next is orthopedic implants distribution, where we've taken a bottom-up approach, where we've taken targets from the individual marketing team and marketing and the sales team, and we've built it up and achieved a top-line number, and then we've rolled down on the costs. This is an area where we had some working capital scenario which we've built in terms of how we can utilize the working capital. We have segment-wise split, and it's a sales-based approach. So I'll run through the hospitality model. Just to brief you how I've prepared this budget is that key operating levers are in the starting of the budget, where we have number of rooms or number of room days, room available per day. We have paid rooms per day. What is the percentage occupancy? What is the ARR? What is the revenue per room? What are the number of guests we are expected in a particular month? What are the food covers? Food covers are typically what will the guest eat in terms of will they have lunch, breakfast, dinner, or they'll have lunch and breakfast, or they'll have only breakfast. These are the kind of areas which we need to get into. There are various bar covers. There are total food and beverage other covers which also take part into, and the number of staff involved. So what I've done is I've given a snapshot of the business matrices and the operating levers which we need to track month on month at the start. This is a P&L which I want to run through you all before. Also what we've done is we've had different income segments where we have room sales, we have food and beverages sales, we have spa sales, we have miscellaneous department sales, interest income. What are the other operating costs? We have payroll costs, we have stores and supplies, food and beverage. So pretty much this is the kind of structure which we built in month on month. Key takeaways from this worksheet is we need to have all the operating and the business matrices at the top of the worksheet. What we need to do is we need to build them month on month so that they are tracked month on month. Also, for a resort to operate, we need to understand that there will be seasonal trends. There are few peak seasons for this kind of resort. We see that the rainy season for June, July, August, where we have maximum occupancy for this kind of season. So this should be able to determine the seasonality, whether we are actually able to generate or not. So this is how we've built the P&L, and we've determined the net operating profit for the year. The second sheet, what we've done is we have done a detailed snapshot of the P&L which I've already showed you. What this sheet also has is other operating levers, is that payroll to sales, payroll percentage to sales, okay, heat, light, power percentage to sales, gross operating profit percentage to sales. So we have gotten few other operating levers. Operating levers are very important to the budget. Then again we have the P&L snapshot, sales and expenditure, and what we've done is we have done a detailed schedule for expenses. So what we have part of the food cost, what we have part of the payroll cost, what we have part of the source and supplies, the administrative expenses, the heat, light and power, repairs and maintenance. So what we've done is we've built in a detailed model. We built a very detailed model to understand that which are the costs which are impacting the current budget. Other operating expenses, for example. Now, what is the current trend of budget is that it's a sensitivity based budget. What we have done is we've linked to a particular matrix sheet, a target sheet. I am just following on the links. Now, what we have done here in this budget is that we've given a sales target to the sales head, where he has given us that within this segment, in a particular month, we'll be able to cover these rooms at a particular rate and get a particular revenue. This is the sensitivity which I have brought in the budget. This sensitivity will actually lead to all the changes in the budget. So this is my base file which I have worked on. This base file has to be linked with all the summary sheets which is required for the presentation. Most important tip is that you need to have a sensitivity based file where you are able to tweak the rates or discuss the rates, that why you have taken certain rates, and then once you tweak it, you are able to actually change the summary sheet. Just to brief you all on this, what we've taken is we have taken different segments of revenue. achieve. For a domestic FIT, for an internet, FIT is free individual traveler. People who are just local, who are coming in, people who are coming only for leisure from out of town, whether we are holding a lot of weddings, conferences. These are the part of segments which we have already built in. What we will do going forward is that this will be tracked in detail month on month, that whether what we've targeted in terms of individual segments can be achieved or no during the particular month. If it is not achieved, then we'll need to understand the reason. Such kind of detailed working will throw questions to the sales head. We had planned this and you have not been able to achieve, and you send me the reasons and whether you will be able to cover up in the quarter or no. These are the few examples which I wanted to run through. The detail of work we have done in this budget is the kind of work which is required for a successful budget. So we have taken various departments and we've prepared departmental profit from them. We've taken revenue, we've taken cost, we've taken salaries, and what is the club profit or what is the departmental profit. To reiterate is that the more operations people are involved in the budget, the more accurate the budget will be, because these are all the operational levers which are adding up to the financial model which we are trying to prepare. To take you through this sheet again, what comes to the understanding is that what we've done as a percentage of sales, please see column AB, where I've done as a percentage of sales. We need to understand that top driving items. We understand that room sales forms 55% of the total revenue and food and beverage sales form 41% of the total revenue. So these are the high value and high business bringing items. Similarly, on the cost front, we need to understand which are the heavy costs for us. Okay, for example, payroll cost. For example, the food and beverage cost and the heat, light and power cost. These are the top costs which are impacting the P&L. What is the next plan of action for this is that we need to build them up in detail. We need to make sure that we cover all the aspects of room sales, food and beverage sales, and on the cost front, we have payroll cost, the food cost and the HLP cost. So what we have done is that we have done a detailed analysis of that. What we've done is that we've taken the departments, we've taken the sections, we have the existing headcount. What we are anticipating is an additional headcount. What are the additional headcounts which are going to add in the next year, and what will be the average salaries? And this is how we've derived cost per employee or total salaries for the current year. So now what will happen is that to achieve a particular level of sales, questions will be asked how much manpower you will require to achieve those budgets. What we've done is we've incorporated the additional headcount. For example, if you require the salesperson, if you require F&B persons or whoever is additional required, this target we've taken from individual departmental heads. What also is a part of this hospitality business is that we need a lot of outsourced labor. How much outsourced labor will be required and what will be the cost, that also we have brought in. We've done a detailed analysis of the major costs incurred. Okay, we've taken the variables as per rate. So all the operating levers we've taken into consideration and derived this. So electricity rate per unit, we've taken the rate per unit, we've taken the fuel rate per unit to arrive at a particular cost. The point is that the more detailed we go into operating levers, the more is a positive outcome on that. Room amenities, room linen, F&B linen, all the small aspects have been taken into consideration. Even the smaller aspects like donations, everything has been considered in a particular budget. A hotel being a capital intensive business model, will also the repairs and maintenance, what kind of repairs and maintenance will be required in which of the departments. So we've broken out into various departments as well. These are the key F&B covers. The key message coming out of this is that we made this in absolute detail. The final outcome is to be presented in this way. As compared to the previous years, what you are planning to achieve, what is the percentage increase, what is the percentage rise, everything is linked. So what I'm giving is that I'm giving 3 years performance in total, where I'm saying my sales will be increased by 13%, will increase the sales in the current year by 12%. My overall sales will increase by 1%. This will lead to a lot of questions. Why, if you achieved 14% higher in the previous year, why can't you achieve 5% more or 4% more? So these are the questions which will come across once you prepare the budget completely. From a finance head point of view, you need to validate this, whether this 15% is enough, whether there is more efficiencies which we can drive in the organization and achieve a higher revenue number. Similarly, on the cost front, we observed that there is 16% higher cost in the previous year. We need to cut down on costs. So which are the costs we need to cut down on, and how are you planning to cut down on costs? So these are some of the questions which will come out of this working sheet. So I hope you are able to understand where I'm coming from. This comparison will overall help you understand that where we stand vis-a-vis last year and the previous year. Are we budgeting accurately enough as compared to the actuals of previous year or not? So this will definitely help you all out. and give a clear picture to the person preparing the budget as well as person approving the budget. So this is it on the hospitality model. Key takeaways from this model are: we need to have a monthly P&L in place. We need to budget on a monthly basis. We need to have all the operating levers which are required to drive the business. Okay, so and the income statement and the expense statement. What also we need to understand is where do we stand at the end of last year and what are the detailed matrices which we want to achieve from the other departments. Basically, it was a mixture of top-down and bottom-up approach where we had taken the top-line number from the management, and the numbers were also received from the sales team. We worked with the management and the team, and we got them in sync, and finally we got the budget approved. This is one of the models which I wanted you to run across. I hope you've been able to capture the underlying message coming out of this model. The other model which I want to show you all is the model which we prepared for an orthopedic implant distributor. Okay, it was a bottom-up approach which we've taken in this model where we built in the budget taking targets from various teams. Okay, so what we did is that we prepared a template. We prepared a simple template to understand that these are the products which we deal in. This is the selling price per product. You tell us how much you want to achieve in the next year, and we've just linked it and kept it pretty simple. Apart from the sales, what is the expected marketing expense you require and approximate traveling expenses you require. These are the individual target sheets which we've taken from each of the regional heads. So regional heads in turn discuss this with the resources which they have under them, and we got the final details. Also, what we've given is a snapshot of overall region-wise P&L in terms of how it looks and in terms of which of the regions will be profitable or lost when we allocate all the salaries, all the cost to them. This is a snapshot what we've given. What we've done is that we've gone to different departments and we've asked them, hey boss, why the sales is low? We've not been achieving the profitability, and you need to change the budget because we do not find it right. What needs to be done is that we need to go back to all these departmental heads, because what they will do is they will play on the safer side. To drive their efficiencies out, we need to again cross question them, review what they've given, and analyze what actually the data is coming across. So that's what we've done in this model. Also, we've planned the cash flow. A few of the areas which we faced issues is we are not able to manage the cash flow out. We've done a working capital management here. The way we've prepared is after the P&L, the balance sheet will slow, the cash flow will slow. The cash flow will give us where we are lacking in terms of the cash month on month. So this is the operating cash flow. So when there is operating cash flow is negative in a particular month, we need to be worried about that. Do I need to get in additional cash or do I need to reduce my expenses somewhere? So these are the areas which we've catered into, discussed, and probably brought it out. Most of the people faced while preparing the cash flow and balance sheet in a particular budget is how do we tally it? These are the common issues which a budget preparer faces. Generally, what we do is that the cash balance of the cash flow is equal to the cash balance of the balance sheet. Okay, so we need to understand where we've made a mistake. We need to keep all the links properly. Cash as per balance sheet and the cash as per cash flow should be equal. The key items coming out of a cash flow is that we need to understand that the operations will be able to generate enough cash flows, whether the working capital cycle is adequate enough to ensure that we go out through a particular month. These are the primary areas we looked in this particular model. Also, we've segmented this in a particular section. The other part we've done is we've prepared an overall summary as to where we stand in a particular year. Okay, so what this summary gives out. Okay, so I've modified it in terms of what are the questions that a person needs to understand where things have not been budgeted accurately. For example, few of the discounts we've not budgeted. So why we have not taken into account? Why COGS is getting so high? Isn't it an inflation adjustment? Do we need to have a cost control on this? So what are the cost control mechanisms we've put in the budget currently? If you see, the overheads have grown by 23% and the overheads are only growing by 49% in the current year. Okay, have we under budgeted it? So once you summarize this and map it with individual previous years, you'll be able to understand where you stand in terms of the budget. So before you present the budget, you will be able to understand these areas needs to be changed, improved, or to be discussed with the departmental heads, and then again rechecked and determine where we stand as compared to the previous years. This is one of the models which I wanted to run you all through. So both are two different models. Both are two different areas of operations, different approaches which we've taken, and so hope you've been able to understand the key messages which I wanted to bring in. We need to bring in detailed areas where we need to focus on. Okay, there are some areas which can be ignored and which can be tracked at a lower level. So what we can do is we can do an 80-20 analysis where we say that 20% of the key items in the budget, they actually drive the budget and they determine the accuracy of the budget. The rest, they can be similar to the previous year as well. Well, I'll again run through the key aspects of what I mentioned earlier by running through the budgets of hospitality as well as the orthopedic implants. To start with, we need to have operating levers. The operating levers are very important, and it has to be a sensitivity based budget. So sensitivity based budget in the sense that we did in the hospitality model, where we linked the sales segment piece to each and every sheet, okay, so that we derived a proper number. So this is a sensitivity based model where you change the number of rooms, automatically the revenue will change. If you change the rate, automatically the revenue numbers will change. Similarly for the cost front as well. For example, ARR, revenue, percentage occupancy, these are some of the key operating levers for a hospitality model. So when you prepare a budget for your company, you need to identify those key operating levers. Okay, you need to put them down in detail and track them month on month to ensure that we are able to achieve the numbers which we forecasted. Similarly, number of surgeries, the purchase price, the sales price for implant model. The key takeaway is that budgeting starts with operating levers, and financials are merely the outcome of the operating levers. The message which I'm trying to bring out is that the operating matrices should be in place in detail. We need to understand what are the operating matrices for a particular business and then build it up as a financial model. The other key matrices to the business, for example, number of clients, customers, product, what is the revenue per client will generate, what are the number of employees, what is the headcount, okay, because it's one of the highest cost in most of the organization. What are the number of orders, number of events, number of conferences you are going to hold. Okay, this determines your marketing cost, number of repeat orders, customers. Okay, so you need to plan all this. What is the realization per SKU per order? So realization of a product. These are the key matrices which you need to bring in. So I'm just giving some of the examples which we need to bring in for your businesses. Keep the matrices levers as a part of the summary. That's the most important thing. Okay, when I presented the hospitality model, we kept that as the top of the P&L worksheet, where it gives a clear insight to the management how the visibility in terms of the trends and the business will work out. At the end, the promoter looks at the business. Okay, so we need to have those operating and the business matrices on top and in highlight form, so that he's able to understand that this is the movement coming across month on month. So again to reiterate, month-on-month visibility is necessary. Okay, month-on-month visibility will be able to understand that in which particular month we've underachieved, overachieved, or we've exactly achieved what we budgeted for. Okay. Month-on-month visibility will also be able to understand that where are we lacking. Okay, why in a particular month we are lacking. Okay, then we'll be able to identify that there are key areas, there are key government policies which have come in, or key changes in the statutory laws, key changes in the service tax rates or something like that. So for example, GST is coming in, so GST rates have been budgeted for or not. So these are the points which will come across, which you need to incorporate in the budget. Moving on, in terms of tools, pointers for the profit and loss statement, I think definitely again a monthly view of the P&L within the budget is necessary. We need to check for seasonality trends in the previous years. So for hospitality, you will have a peak season period. Okay, whether you incorporate that peak season in the previous year, the previous year's trend is coming in the current year or not. Okay, all those checks and balances need to be there when you are preparing the budget. Other areas are the percentage of total cost and the percentage to sales to assess the accuracy of the movement. So in percentage terms, you'll be able to understand. The percentage will determine that, which are the top indicators in terms of going into value wise, because the numbers may be quite high, but you'll be able to easily check on the percentages and judge and determine that whether the percentage actually justifies or it makes sense. Okay, what also we discussed that the revenue assumptions need to be in detail. We need to ensure that there is enough revenue. We can manage the spend. So it has to be detailed, segment wise, department wise, region wise. Identify the top 3 costs and build them in detail. Payroll is one of the heavier costs where you need to understand what are the headcount movement month on month. So the ratio of payroll to sales, is it matching or not? Okay, so that is the key ratio which you can come across, which you need to bring across in your operating levers, where you'll be able to understand that if the sales is going down, then why this headcount is required in a particular month. So such kind of ratios. These are all few of the checks and balances while preparing the budget. I think administrative costs, all the other costs, I think what you can do is understand which are the factors within the administrative costs and build them up in detail. Few of the items can be ignored in the sense that we can take the same percentage of the sales as we did for the last year, for example telephone, internet, and do a percentage incremental to those costs and then build up the budget. That's okay because they will not impact the budget so much. However, they will be in certain limits within the previous years. What you need to do when you finalize the P&L is that you need to finalize up to the EBITDA level completely. Once your EBITDA is set, once you've done all the checks and balances, I think you'll be comfortable going ahead. Depreciation and finance cost and tax will come later on. Depreciation will flow definitely from the capex. Once we go to the balance sheet, we'll discuss this a bit. How much capex is required during the year, or the current capex which is available will be able to sustain the growth of the business. Finance cost will also come on the basis of the existing debt and estimation of new debt which is required. We need to estimate what kind of money is required to achieve that vision. The tax planning, I think corporate tax can be decided 25%, 30% based on the turnover. So we're just incorporating the budget tax rates which have come in. So you need to determine the turnover and check and build the corporate tax. But before that, you need to understand whether there are any carry forward losses available. If available, do not provide for tax. Carry forward losses, because the losses are carry forwarding from the previous years, it does not make sense to determine the tax rates because we'll get that benefit. These are the few pointers for a particular profit and loss statement. Coming on to the balance sheet, we need a monthly view of the balance sheet as well. First, we need to understand the current capital cycle. In how many days we are making vendor payments, what is the current cycle, and incorporate that current working capital cycle in the budget, where we are saying that we are paying 60% in the next month and balance 40% in the succeeding month. We need to incorporate the same in the budget. Typically, if we are paying at 45 days, that needs to be incorporated in the current working capital cycle. So most of the companies face issue where the receivable days are higher and the payable days are much lower. We need to identify what is the current and how we can reduce the receivable days to improve the cash flow. The questions coming out of this is that what will be the collection strategy, how we can reduce the day sales outstanding or the receivable days every month. What we can do is we can target something within the budget saying that if the receivable days are 30, we will target 25. So these are the targets which we can plan for in the budget and we can incorporate them in the working capital. Once you incorporate something into the budget, the justification should come that this will be the target taking forward. These are few of the processes which we'll look at and cater into to ensure that the receivable days are reducing. So there is continuous follow-up, reminders, pressure on salespeople, pressure on collections, pressure on vendors, multiple reminders, date of reminders. So what does a budget do is derive a process within itself when the key questions are asked. Once you understand the working capital, whether the working capital is enough and the working capital is positive, the operating cash flow within the cash flow is coming positive. So that's the area which we need to look at. If it is negative, then there is something to worry about. And then we need to reevaluate and check whether what we've been doing in the previous years have been correct or incorrect. Accordingly, prepare the working capital cycle. The next step is that understand whether your current business is capital heavy or capital light. So whether there is a lot of capex required or existing capex will be enough to suffice the business. Once you prepare the capex budget, the depreciation working will be part of the capex budget. So assessing whether it is a capital heavy or capital light model, that needs to be done by the finance head and put that in the budget or somehow estimate the capex required. Now, if it's a capex heavy model, how will you get the capex? What are the existing limits available with me in terms of debt? Whether I will need to increase those limits. To further increase the limits, do I have a collateral or not? Do I have an interest payment capacity? So once you incorporate, these questions will rise and we'll be able to tackle and find some answers to this. Then understand what is the debt required and we go out in the market searching for debt. The capital requirement. If the debt option is not working out, what is the cash requirement planned out of equity capital? Do we need to talk to the existing shareholders to bring in additional equity, or do we need to bring in additional shareholders? There is a typical issue for a startup where we need to bring in equity capital so that they're able to survive. We need to understand that what is the cash requirement of equity capital. Also, what we need to do is check whether the existing liquidity is available in the business or we go for a fundraise. The key pointers I'm trying to make is that we need to, so I'm taking each and every area of a budget, the operating levers, the P&L, P&L, the balance sheet and the cash flow, and the key areas which determine the accuracy of the budget or the success of the budget. Moving on, cash flow and ratios. If you are giving a monthly presentation of the balance sheet, the P&L, we need to also give a monthly presentation of the cash flow. We will be able to understand the working capital, the operating cash flow movement month on month, and understand where the operating cash flow is negative. So how we will sustain and how to improve that within the budget, we'll find that. So we have two methods, direct, indirect. Indirect method of cash flow will give a clear picture on operating cash flows as well as profitability in terms of additional cash which is required in the business. Most of the finance heads have a lot of problems in telling the balance sheet and the cash flow. All the assumptions are put in. The balance as per cash flow should be equal to the amount as per balance sheet. This will give a clear picture. So the idea is we need to go from cash flow to balance sheet rather than balance sheet to cash flow. And the key ratios which we need to actually look in is accounts receivable days. These are very important from a working capital point of view. Accounts payable days, inventory days. Have we blocked too much cash in inventory? Our sales to working capital cycle, whether the working capital is in sync with the sales, how much capital we've employed, how much return on capital we're getting, how much return on equity the shareholders will get. Okay, some of the profit and loss account ratios which I feel should be a part of the budget are interest coverage ratio, sales to marketing spend ratio, and the normal GP/NP ratio. This should give you a clear picture in terms of your profitability, your revenues, your working capital, and the capital employed in the business. This covers all the important aspects which a promoter will look into or a business head will look into. These are the key ratios which I feel should be a part of the budget. Just to sum it up, we've discussed on the operating levers, the business matrices, P&L, how the P&L should be presented, how it should appear, what are the checks and balances within the P&L, what are the checks and balances in the balance sheet which you should look at, what are the questions deriving out of the balance sheet, what are the areas which we need to look at cash flows, and what are the key ratios which are important from a business standpoint are all to be incorporated in the business. Also, we need to check those ratios. We need to compare everything to the previous years. The incremental percentage is making sense or not. Also, the key thing here is that we need to actually budget something where we can measure it in actual terms. So the problem we face is that sometimes we budget something which is actually not in the normal routine or out of the trend, and we incorporate in the budget. And when you compare it with actual figures, it is nowhere seen in the actual figures. So definitely you'll find a variance. The key message here is that we need to budget whatever is actually measurable. Once your budget is approved, ready, the final outcome is that you need to monitor the budget. How will you monitor the budget? Many of you all sent across monthly MISs. So what we do is we incorporate the budget format as per the MIS format. We'll be able to easily compare the actual numbers with the budget numbers and then identify the variance. What will also lead is that we'll be able to compare month on month. Because we prepared the budget month on month and the MIS goes monthly, we'll be able to understand month on month. The decisions which ideally should come at the end of quarter will come within the month, or decisions which are coming at the end of 6 months will come in that particular month itself. So you are able to actively convert that decision into execution and take corrective measures and understand where you stand as what you thought. So budget monitoring is one of the most important aspects of the budget. Okay, the depth or the detail of the budget which you prepared should also be highlighted in the MIS. So the MIS will give you a correct picture in terms of where you stand today vis-a-vis what you budgeted. This will drive decision making. What also you need to understand is that in terms of quarter, okay, suppose 1 month may be slack because of some other areas. Okay, we sit at the end of the quarter and understand that this is the number we achieve, this is the number we targeted in the quarter, and this is the number we've achieved. What is the variance quarterly? Is it too high? Is it too low? Whether the balance months will be able to cover those. So the key meeting with all the departmental heads, taking in the CFO, the management of the promoters into that meeting and do a quarterly review that will justify the effort put in the budget and justify the decisions coming out of meeting, and everyone will be targeted to achieve the balance part of the budget. I would recommend that there will be quarterly reviews of those budgets. What I want to show you all is how a template looks like when you do a budget monitoring. This is a monthly budgeted number and the monthly actual numbers. Okay, and what is the variance month on month? What is the YTD achievement in terms of budget and what is the variance? This will give a detailed snapshot of the P&L, similarly balance sheet, and similarly cash flows, where we stand in terms of what we're budgeting vis-a-vis actuals. So these are the draft templates which I wanted to bring about. So now for example, there are few numbers which I have tweaked to make sure that there are decisions which are coming out of the presentation which I'm trying to show. For example, the HIP sales. The HIP sales are below budget by 2.81 crores. Why the HIP sales has declined overall? Few of the quarters there might be have discussion that because we are not able to get certain capex instruments to service those implants, or And you know, other areas, a key manager leaving the person, so okay, leaving the company, all that factors need to be I'm sorry, sorry, people are not being able to see this. Just change it. Okay, sorry. Okay, sorry. So for example, so I was speaking about this, the budgeted. So I've tweaked. I hope everyone is able to see the Excel now. Okay, thank you, Shantanu. The HIP sales. So I was iterating at the HIP sales. Why are we under budget? Okay, we are sitting in Jan and we are under budgeted by 2.81 crores. What are the reasons for that? Some of the decisions, some of the areas, for example, sales, some of the costs are very high. Some of the specific areas. So what we can do is we can help the specific segment heads or the P&L heads who are actually responsible, who have actually given the budget, and we can question them why this not been achieved or why it has been achieved. What are the mitigating measures you're going to take to achieve this in a particular time span? Some of the factors may not be in your control as of now. Some factors may arise later on as well. The idea is to keep it as realistic or as simplistic as possible and do some provisioning for few areas. This is pretty much it in terms of how we can measure in terms of budgeted versus actuals for balance sheet and cash flow once we prepare the budget. So this forms part of the MIS. So this is in terms of the monitoring mechanism which I wanted to show across. Key takeaways for a person preparing a budget. Okay, so I've just the takeaways I've broadlined into some of the key heads which will probably send the message over in the right way. Now, communication and allocation. You need to provide templates to the departmental heads, and easy templates to departmental heads because they are not Excel savvy. Most of them struggle with Excel. Okay, so we need to give them easy templates so that they are able to just put in the numbers and then we derive a number. So a sensitivity based product pricing. So we just enter the number of products and we get the pricing. There will be different templates for different departments. You need to make the departmental head understand the template first so that he is not confused and he does not come back to you again and again. So spend that time with the departmental head. Okay, spend adequate time with the departmental head. That's what we are trying to do out of this template and how we are trying to bring a value out of it or your target out of it. Provide sufficient timeline to come back. Where we struggle is that we are too hesitant, and because there's too much pressure from the top, so we kind of pressurize the people who we ask details from. The idea is that we need to plan really well as accounts head, finance head, and we need to give sufficient time to the departmental heads to come back. The longer the time given, the better the accuracy of targets you will receive. Okay, the better the thoughts you will get. Okay, why a particular month is like this, or why a particular month is not correct, or why a particular month is correct. In terms of modeling, all the individual Excel sheets in one master Excel file. You need to club all of them in one master Excel files. You need to link all these departmental P&Ls to the main summary sheet. So the main summary sheet will be able to understand the macro picture of the company vis-a-vis the comparison with the previous years when we budget. So this will give an overall snapshot of the budget. So please keep one file. Don't keep multiple files when you're presenting, or keep one file for you to access every time, and link it thoroughly. Okay, include all the departmental tabs and do a hygiene check again of the links in terms of whether the links are accurate or not. So these are the key takeaways for a person to prepare a budget. Okay, these were on the execution part. These are on the thought process part. Okay, on the thought process part, you need to preempt the questions. Okay, preempt the questions which will come from the CFO or the promoter. Okay, so few of the questions which you might receive, okay, you need to preempt them and already include that in the budget. Okay, so few of the questions, I've just given few examples that whether we've included all the departments within the budget, whether any department is missing or not. So once you have all the departmental tabs which are highlighted in a specific color, then this gives a comfort to the CFO and the promoter that all the departments are there. What is the increase as compared to previous years? So that summary sheet, this will give a snapshot to the CFO that this was the top line this year and this is by 15% is increase in the current year. What is the existing debt on books? How much is required will come out of the cash flow, whether your working capital is enough or whether there is enough reserves or enough money in the business to actually achieve the targets which I mentioned. Check whether there is cash negative in any month. Okay, so in one of the model which I showed, there is cash negative in the month. Then the next question will come, what is the monthly working capital requirement? So your operating cash flow will determine how much working capital you require on an average. Then how much additional cash is required. When will we require additional funds? So in the month where negative working capital cycle is going is the month where we'll require additional funds. So once you present the cash flow, and if you see some of the months are going negative in terms of operating cash flows, you will be able to justify why it is going. Okay, there are few collections which have been delayed. There are few vendor payments which were required to be made in advance, something like that. So few of the explanations, the questions you should preempt and do corrective measures before presenting the budget. The other is, what is the peak revenue month? I think month on month, if you present, so you'll be easily able to understand that this is the peak revenue month, which is the peak cash flow month. What is the employee cost as compared to previous years? How much additional headcount have you taken in the current year? So these are the questions which will actually come out from the CFO or the promoter. What I suggest is that we build the budget in such a way that all the questions which we expect, we think about that and we build the budget in such a way. Moving forward is logical test based on previous years. What we've achieved actually in the previous year and what we are budgeting actually makes sense. Check the data provided by various departmental heads. Understand them. What basis they have taken to give this data. Departmental head, in their hurry, they might put any number. Okay, we need to ask them and ask them to justify that. Once you are confident of that data, take that, approve that, and then incorporate in the budget. Do a ratio check. We discussed on the key ratios which actually drive the business: the receivable days, the payable days, the GP ratio, the NP ratio. Just check whether they are in sync with what is there and how better we want to make it in the current year. Develop a process around that. So when you're justifying the budget, saying that, okay, we want to do this and this will derive efficiency, you will have to have a process around it. So what you're doing is you're preparing the budget and preparing a process also around with the budget. What determines the success for preparation of budget? Less number of iterations. If you've thought through each and everything in detail, you incorporated, you've taken even the slightest, minutest details, you covered all the important elements in the budget. Once you're able to answer all the questions which come from a CFO or the promoter, and there are less final iterations, I think that determines the success of a budget. Preparation of a budget. Budgeting is a process, not a one-time activity. We budget every year, right? So budget is a process. Like a process, it needs to be continuously improved. What we do is that we budget in a certain way in a particular year. We take that base. We see that we've achieved, 90% of the budget. So the budget is accurate. No, it is not accurate. The budget needs to be more accurate. How? We need to understand the final aspects. We need to evaluate whether we've covered all the business or operating levers, make it further detailed to improve the accuracy of the budget. Thought process is you need to go into detail of all the important items which are impacting the budget and go into detail so that you are able to determine the accuracy of that. So what are the latest budgeting trends which we've observed? We've seen a lot of models are available which are sensitivity linked, so which I explained you. If a particular revenue or a particular product, if you reduce, automatically the overall budget changes. So now a lot of sensitivity linked models are available, actually used by a lot of companies. Tools like IBM are available to help in easier forecasting. These are online available tools. Once you search IBM budgeting, you'll be able to get, these are the tools available. You can easily log in and get the feel of the tools. What is happening now? What are the trends we've seen in more of the sophisticated or process-driven companies? Is that we are moving to a 12-month rolling forecast instead of seeing the budget as an annual exercise. So we evaluate this monthly. We prepare a forecast month on month and change the forecast based on the actual happenings of an event. These are few of the areas which are currently in trend, which we've observed in few of our clients. For example, a startup, you never know, what's going to happen in the next month. A 12-month rolling forecast will definitely make sense instead of annual budget exercise, because every month there is something new happening in the startup. A 12-month forecast will be good enough for our startups. There are few other online budgeting websites which are available. You should just check them out for your reference. Is that budgetpulse.com and budgetsimple.com. So just check them out to understand the feel. These are free online budgeting websites which are available. They have the demo session. If you could just go through them, probably you will have better clarity and approach to a budget. This is pretty much on the budgeting aspect. I think I've covered all the finer aspects and the key messages. I hope it's given some of the insights and some of the areas which you can incorporate in your company. I hope it's been helpful for the budgeting part. Now, business plans are generally 2 years, 3 years, or 5 years. Why do we prepare a business plan? What we want to achieve in a particular year or years, we'll be able to understand. At what year we'll be achieving a particular milestone will be determined by the business plan. Now, steps before developing a business plan. Why do you need a business plan? A is you require it for valuation. B is you require for funding. You need to ask those questions and then prepare the business plan. If it's required for the valuation, then you need to prepare the valuation sheet, understand the valuation which is derived out of the working, build vision. Where do you see your company in next 5 years? These are the questions you need to ask before preparing a business plan. Ideally, the business plan can be an extension of the budget. What we can do is what we've prepared as a budget, we can extend it for year 1, year 2, year 3, year 4. Importance for a business plan is the assumption sheet which we prepare. Very important is that we keep all the assumptions which we are putting month on month in a particular assumption sheet. Those assumptions can be for the business matrices, the operating levers, the P&L assumptions, the balance sheet assumptions, the cash flows. Everything has to be in one assumption sheet. What you need to do is just link the assumption sheet accurately to your P&L, balance sheet, cash flow. Year on year, once you want to change few of the assumptions, automatically it gets reflected in the balance sheet, P&L, cash flow. I have a simple business plan which I have prepared for one of my clients. This business plan is for a digital sports media. It's a different concept altogether. Which are the key matrices? We prepared it to get the valuation. So what was the valuation strategy we used? And we prepared it for the investors. I'll just run through the business plan. The way we've done it is prepared a P&L. Same what we've done is an operating matrices. Basically, it's a digital sports media company where a number of videos drive the business. We have different model segments which we've come in, and which is the gross margin. So these are the key operating matrices which you've seen. Other matrices, the number of views per video which we brought in, the overall P&L which we've brought in, the utilization we've brought in. So what we've done is a P&L come cash flow for operating cash flow for the company. What we've also included is the other financial matrices, the monthly one, the gross margin, total operating expenses vis-a-vis total number of videos, total direct cost vis-a-vis total number of videos. So what we've done is we've given detailed matrices to ensure that they are in sync with what we've actually planned. This is the summary sheet. This is the cash flow. What we've done is we planned for the infusion of cash flow in a particular year because the cash flow was going negative, and we identified that if we get the funding in a particular year, we'll be able to survive for the next 5 years. So these are the balance sheets year on year. The detailed assumption sheet, this is the 5-year-old revenue plan. We've gone in extreme detail to understand, what are the components of gaining the revenue and what are the segments. There are different segments available. So we've done it in detail. We've also have a cost plan year on year. We have this pipeline, which is the key operating lever which derives the overall profitability or the overall matrices in the business. We've added the working capital cycle. This is a planned working capital cycle which we've done. We've also given a small snapshot of the fixed assets which is required. So it's a very simple model which I'm trying to explain. The main idea was to derive a valuation of this business plan. So we've just added a simple sheet and derived the valuation for this business plan. A very simple, very straightforward model. Understood where will be the cash requirements, understood the key matrices which the investor will look into, and we've incorporated that. What is the revenue which we are planning to generate at year-on-year revenue generation? What will be the cost involved? What is the margin which we are going to generate? Which of the segments will be beneficial, profitable? Which of the segments will not be profitable? Why it will not be profitable? Are all the key elements which we've considered in preparing this business model. This is the business plan which I worked on. What are the key benefits arriving out of a business plan? It's like easier to communicate plan, objective, and strategies to bankers, potential investors, and employees. So the easier the model, the easier the assumption sheet, the easier the easier description of what you want to achieve will be easier to communicate to the potential investors. Okay. While preparing a business plan, you need to gain deep understanding of the market. What are the peers doing in the market? How are they placed? You need to do a peer comparison. You need to ensure everything is there in that business model. Whatever plans are there in the year 1, year 2. So for example, we saw that in the second year, we need to bring in cash. So that funding strategy should be in place for year 2. Who's going to do that? Which are the key investors we need to look into? So all these details will drive out of that business plan. Like I mentioned, the capital requirements. We need to understand where we may need external assistance on certain areas to kind of achieve what we vision for. Overall, we'll be able to understand what are the milestones. It's basically the addition of a budget, the nitty-gritties and important final aspects which we've covered in the budget should be covered in the business plan. The business plan cannot be as elaborate as a budget, which I understand, but it should cover all the important and the final aspects. This is pretty much it for any queries or any queries with respect to your businesses, any processes when you're building up the budget which needs to look into, you can definitely reach out to me. I hope this session was helpful to everyone who's going to work on preparing the budget. I hope the key messages have come across. Please do write your questions to me. Happy to help in your specific business. Happy to engage with you all. Thank you very much for being part of it. Thank you so much.